Okay, dear students, welcome to our last presentation on mutual funds. Very important, investments for the masses. And in this last presentation, we'll take a look at fund families. We'll see what those are. And then we'll do some odds and ends, but we're going to key on a specific, just one mutual fund out of 12,000 and see what kind of long-term wealth we can build with a simple mutual fund that invests in stocks, some growth, some income stocks, a growth and income stock. It was created before the growth and income phrase was even thought of, but still, it's been around a long time, and we'll see how that one's done. And then we'll end with some final thoughts on mutual funds. So let's get started on slide 16 with fund families. A family of funds exists when one investment company manages a group of mutual funds. Now, this didn't used to be the norm. Most companies had one, maybe two mutual funds. Up until the 1980s and 1990s, when the industry just exploded and everybody was coming out with a global long-term growth and income fund and a short-term global junk bond fund, and so pick one from column A, one from column B, and one from column C, and you wind up with thousands of funds. So the fund family has dozens, sometimes hundreds of funds in their family, and you can move your money from one fund to another, usually with no charge whatsoever, because many of them you've paid an upfront commission, right? The traditional A shares. But be careful. There are going to be tax consequences. If it's in a taxable account, you are going to generate a 1099, a form that it gets sent to the IRS and gets sent to you. And because the IRS says, hey, you moved from one mutual fund to another mutual fund, that's a taxable transaction. If it's in a retirement, a 401k plan, a Roth IRA, traditional IRA, no, they don't care about that moving it within the account. It's only when you pull the money out. So that is why Forbes, a long time ago, and I wish I had said it, said choose a family, not a fund. Look for a company that has a family of funds that have done well in good times and bad times over decades. And here are the top 10 mutual fund companies by size. Now, the problem with this is that it depends on who you talk to. There are some different issues. Some people don't actually understand the companies that well, and they'll put BlackRock first above Vanguard. BlackRock is the number one global money manager, but they have other types of investments other than mutual funds. So they do have more investments under management than Vanguard, but they don't have as much in mutual funds. So Vanguard is the number one mutual fund company in the world. And then BlackRock. Fidelity used to be number one, and then Vanguard with their index funds overtook them. And Fidelity said, well, let's create our own index funds. So they have index funds. This company is a bit of a, number four, is a bit of an enigma. They call themselves the Capital Group. It used to be actually just Capital Research and Management, Capital. But everyone started calling them the American funds. And I think I've mentioned this already before, right? Because they have funds like the Investment Company of America and the Growth Fund of America and the Bond Fund of America. So, hey, we're the American funds. But now they're doing something that personally, if they had asked me, I would tell them, don't do this. They're going global. They're already in other countries, but they don't want to be known as the American funds all around the world. So they're going back to their original name, the Capital Group. But everybody in the United States still calls them the American funds. So if it were up to me, I would say, look, you're the American funds in the United States. You're the Capital Group funds outside the United States, but they don't ask me. State Street Global Advisors is one of the companies that really pushed ETFs, exchange traded funds, and they have done very well. Boston company. T. Rowe Price has been around for decades and have done well in good times and bad times. They're based in Baltimore. And Mr. Price was one of the first investors, not the first, but one of the first. There were a few back in the 1950s and 60s that was looking outside the United States. Everyone just thought, why bother looking outside the United States? But they have some really great funds. Invesco is a conglomeration of a few different companies. You might have heard of Oppenheimer, but they got bought by Invesco. I'm not that excited about them. Dimensional Funds Advisors, people usually call them DFA. And they're very, very popular with investment advisors, with brokers, with financial advisors. They have some really dynamite funds, so they're a good company. And PIMCO, Pacific Investment Company, they're based, believe it or not, up in Newport Beach. They for a while had the world's largest bond fund, and they've got some pretty good funds. I like companies that have a solid, list of companies, of mutual funds that have done well. PIMCO has some that are great and some that are not so great, and that just turns me off. That doesn't mean you shouldn't look at them, folks. They've got some really good funds. And then Franklin Templeton. Remember we talked about Sir John Templeton? Right. Franklin Funds and Templeton Funds merged. And it's run by a woman, by the way, so check it out. And they have some great funds that have been around for decades and done well in good times and bad times. But they bought the company Legg Mason, and you remember Mr. Bill Miller? And I thought, why are you buying Legg Mason? But I don't know. She's not going to ask me my opinion. But let's wish them well, because they have some really good funds, by the way. So check out the Dynatech Fund, very exciting fund, but risky, but very good. Guy who runs it is pretty darn sharp. So in the face-to-face class, we would now run and take a look at many of the different funds that are available. And we'd show you some from Vanguard, some from American, some from Fidelity. On the website are links to 6 companies, which I think are good companies, and you can take a look at their offerings. The one I really want you to take a look at is Fidelity, because, as I said, I don't know if you remember, but Fidelity is a very good marketing firm. They're very good at it. And they have teamed with thousands of mutual funds. So if you go to their website and you get a Fidelity account, you can buy all of these mutual funds. Is that a good thing? I don't know. Because Fidelity has some 500 different mutual funds alone, Fidelity. And then you can buy thousands more. And you get that deer in the headlights stare from people who go, well, I don't know, which one should I invest in? So please do check out the website, check out Fidelity. Check out Vanguard, check out American, T. Rowe Price. Who else? I have Franklin Templeton. And then I have another company that's not in the top 10, but it's been around for a long time and a very sharp company called Dodge & Cox, based in San Francisco. And they have a wonderful website. They have lots of insights they'll give you and tell you what they're thinking about, what's going on with the economy and what are good investments. They only have 6 or maybe 7. For years, they only had 2. And then they added a third one, and then they added a few more. Where other companies, like I said, Fidelity has 500, Vanguard has 200, American has like 60 or so. And so they only have a few funds. And they say, look, no, we don't want to do one from column A, one from column B, one from column C. That's not in the best interest of our clients. And I agree with them. I'm definitely a Dodge & Cox kind of fan, and so check them out also. But folks, there are dozens and dozens of companies, and that's the hardest part of investing in a mutual fund. How do you pick a mutual fund? Well, stick with us. Oh, by the way, I forgot to mention, because of the mutual fund scandals of 2003, 3 companies that were in the top 10 are no longer there. Wait a minute, Piano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yeah, matter of fact, I do. And by the way, it wasn't that big a deal. It wasn't good. But Since 1940, the mutual fund industry has been regulated and escaped any hint of impropriety. Like that word, impropriety? It means hanky-panky, trucos, travesuras. In 2003, some practices that were not quite illegal, but obviously unethical, were uncovered, and only a handful of funds and people were affected. At Alliance, which is a very good company, but it's morphed since then. It's now Alliance Bernstein, and they changed their name to AB, and AB, what a silly name. There were 2 people at Alliance, 2 who were doing this, and the whole company was tarred with a black paint job, a black marker. The whole company was attacked. Putnam, poor George Putnam, one of the nation's oldest companies. George Putnam rolling in his grave. Bank of Armenia, well, I expect that from Bank of Armenia. Janus Funds, and then the one that breaks your heart is Strong Funds. This one gentleman, Dick Strong, started this company from scratch, built it into this big, strong company, and at the time he was worth like 600 million or something like that. I don't remember the exact numbers, but he was doing these shenanigans along with several other people. Not that many, really, when you consider the industry is so huge, but still, it was only a handful of people and a handful of funds. And supposedly he made like 80,000 or whatever dollars doing this. This guy was worth $600 million when he did this. Unbelievable. To you and me, that's a lot of money, $80,000. But to somebody who's worth $600 million, it's weekend money. And he was doing it as he apologized. He very contrite. He's been barred from the industry, and he accepted his punishment. He said, look, because he didn't do anything illegal, folks. He said, I let everybody down. I destroyed my most important asset, my good name, and I am truly sorry for what I did. Because he said, you start to believe all the wonderful things that people say about you. You start to believe that you're invincible, that you can do anything and get away with it. And it brought him down. Hubris, if you're into Greek mythology. Now, what were they doing? Okay, it's kind of hard to describe, but essentially they were stealing fractions of a penny from their fellow investors in the mutual fund. They were shaving off. Of course, when you have millions of people investing in a mutual fund, 0.001 cent times a million is a lot of money. And they were doing this over and over and over again. And so you didn't lose very much money. You probably lost a penny, if that. Maybe you lost a penny. But it's not like losing $99,999 on a $100,000 account. Enron. And if you don't know who Enron is, we discussed them in the 123 class. Look them up. The biggest accounting fraud in United States history. Yeah, people who had Enron stock lost everything. It just collapsed. But if you were involved in one of these mutual funds, you might have lost a penny. So it's not a big deal, but it's not good, right? And most companies did not do this stuff. They wouldn't do it. And when it was uncovered, it was a big scandal. But it didn't do anything illegal, right? See, that was the problem. It wasn't illegal, technically, what they were doing. But now it is. All the stuff they were doing, no more. Verboten. It ain't going to happen again. Yay. Okay. All right. So what we hoped, and not in a mean way, folks, is we hope you have that deer in the headlights stare. You have that sip from the fire hose. How do I pick a mutual fund? Out of thousands of them, how do I pick one? Well, I'm going to tell you the truth. It's not easy, right? It's not easy. Many people succumb to advertising or what some goofball on the telly or the internet told them to do. But if you're good, folks, and if you want to do well, listen to me. Don't listen to any of them. Do your research. Get good referrals. Maybe take Business 123, Introduction to Investments. Do the assignment in Chapter 14 and dig. And if you enjoy this research, that's a very good sign that you could be your own investment manager. You could have a job in the industry. The industry needs you. And if you don't enjoy it, that's another good sign that maybe it's better for me to have a financial advisor, somebody who I can talk to and can recommend funds for me. There's no right or wrong in this, folks. It's just the way it is. Some people enjoy the research and the time that it takes. It becomes a hobby and a career, and it's a lot of fun, in my humble opinion. Other people would rather eat barbed wire. So that's why there's chocolate and vanilla, and some people like strawberry. So for what it's worth, here are my recommendations for picking a mutual fund. Pick a mutual fund that invests in high quality stocks or bonds. Okay, Piano, how do you define quality? Well, that's another problem, isn't it? Quality is in the eye of the beholder. I know it when I see it. Is well diversified, not concentrated, but well diversified across several industries, sectors of the economy around the globe, in my humble opinion. Although some people say, no, stay in the United States, it's big enough. I like to give my money manager the ability to go anywhere in the world. Has a long-term perspective and a manager, or better yet, as we discussed in the previous presentation, a management team with many years of experience. You want to avoid companies that shuffle their managers every few years. I'm looking at you, Fidelity. That used to be most of them. They used to say, look, here, kid, come, you just got out of the best school in the nation. You're a whiz-bang genius. Here's $1 billion. Go get them. And you knew, you're not stupid, right? You're one of the smartest people to come out of the university system. You knew that you had about 2 years, 18 months to 2 years to perform. And if you didn't perform, oh well, you're out the door. So it encouraged people to take undue risks and choose investments that they might not choose for the long term, but maybe for the short term, just to get a good return so that they can keep their job and be showered with love and attention and a whole lot of money. Well, with some companies that worked fine if you got a good manager, and it worked very unfine, very badly if you didn't get a good manager. And so now the industry knows we need to think more long term. And given the fact that some of the companies that had teams of investors like Dodge and Cox and American Funds and T. Rowe Price did very well, they have been copying their team approach. So I like that. I think that's pretty good. And most importantly, I think I've already said this a couple of times. I've said it more than a couple of times. You want to see mutual funds that have been around for decades and perform consistently well in good and bad markets. Don't tell me how well you did in a good market. Any idiot, yours truly included, can do well in a good market. Everybody does well. The saying is, a rising tide lifts all boats. I want to know how well you did when things were not good, when the organic matter hit the ventilating device. The saying is, when the tide goes out, you can see who was swimming naked. So here is a single mutual fund, folks. And the reason we concentrate on this one is because of its longevity. Don't run out and buy it. I'm not saying you should buy it. In fact, this is not the mutual fund that I normally would recommend to people. Why? Not because it's not a good fund. It is. It's been around for 88 years. And it will be 89 years at the beginning of 2023. It's because it's domestic. And that means it kind of swims in the United States. They can do outside the United States, but not a whole lot, like 20% outside the United States. And as I said, I want my money manager to look for the best company no matter where they are. But that's not why we're looking at it. We're not looking at it because yes, buy it, no, buy it. We're looking at it because it's been around for 88 years. And remember we said 8, 9, 10% for a stock fund? These guys have done close to 12. And before 2022, they did 12. And they're down to like 11.8 or something like that. And they're not alone, folks. Don't get me wrong. There are other mutual funds that have done 10, 11, 12, 13 or more. So there are mutual funds that have stood the test of time, and this is one of them. And now in the face-to-face class, we would look at these ancillary presentations about stocks being risky in the short term, yes, but in the long term, no. Right. If you have the benefit of time, so you want to take a look at that presentation and that graphic, and there's a presentation for, a commentary for the benefit of time. So look at that graphic, and then what if it's not, but now's not a good time to invest? Look at the worst day, best day graphic, and there's a commentary for that. It turns out that even if you chose the worst day of the last 20 years, as opposed to the best day, you still did pretty darn well. You didn't do as well as you picked the best day, but you didn't do that badly by picking the worst day. And you, as a little person like me, are going to be investing every month, right? You're going to be putting $50, $100 more if you can afford it through your 401k, 403b, through your Roth IRA, traditional IRA, into this mutual fund. So sometimes you're going to pick the worst day, sometimes you're going to pick the best day, and usually you're just going to pick an average day. And there's a presentation that shows how well this mutual fund has done over 88 years, and it will astound you. They have turned $10,000, and don't ask me why the industry uses $10,000. Who has $10,000 to invest lying around the house? But that's what the industry does. Talk to the Securities and Exchange Commission. I'm not in charge. They've turned $10,000 into over $200 million. Now, it's fallen since the end of 2021, when it was like 2 something. It's down to 188. Oh, my dear. Down to 188 million. It shows you the benefit of time. And so, okay, I can hear you. But I don't want to wait 88 years. No, of course not. No, you don't have an 88-year perspective. That's why we have the illustrations. So check out the presentation and the illustrations where we did $100 a month for 30 years, $100 a month for 40 years, $100 a month for 40 years, but then increasing every year by $10. And then we looked at somebody who maybe only has a 20-year time frame, has to put in $500, or if they can afford it, married couple, they've paid down the debt, maybe $1,000. Some people are paying $1,000 a month for their cars. How did you do? Yeah, so it turns out that the news is actually pretty good if we are prudent, if we don't try to get too greedy, if we don't panic, if we're consistent, and if we have a lot of time. We've done pretty darn well. But what about market downturns? What about when the organic matter hits the ventilating device? What about when you hear people saying, "Oh, is it too late to get out? Run for the hills." Keep a long-term perspective and dollar cost average. What a horrible term. And sometimes you'll see a hyphen here and sometimes you won't. So sometimes I do it and sometimes I don't. We already discussed dollar cost averaging, didn't we? We're ending at the beginning and beginning at the ending. We said you just don't bother to try to decide when the best time to invest in. Every month is a good time to invest. $50, $100 a month. I wish I could come up with a better name. Systematic investment in systematic automatic investment system. I don't know. I think it's a terrible name, but that's what you hear people say. Dollar cost averaging, I think, is the best. I've tried to come up with a better name. I haven't. And this is the best part, folks. When you dollar cost average, there's always good news. Next morning, you wake up, the market's up. Good news! Yay! Your account is worth more. Your $200 is now worth $200.35. The market's down. Good news. But, huh? What are you talking about? How could the market, oh, wait a minute. Right. When do you want to go to JCPenney's or Macy's or whatever? When they're having a sale, right? Next month, you're going to get more shares at a lower price when the $50 or $100 comes out of your paycheck or your checking account. I know it now sounds all boring, but as we said when we started investing, Boring is good. It takes the emotions out of the investment. And folks, there's two parts of investing as we hammer away in the Introduction to Investments class. There's the intellectual part, which is actually very straightforward. Once you learn the material, it's not that hard. And then there's the emotional part. That's very difficult because we're not rational individuals. And as Warren Buffett, famed investor, likes to say, investing is simple, but it ain't easy. And he's right. So dollar cost averaging is about as close to you can get to a drop dead simple investment strategy. Now, it's not perfect, right? If you're dollar cost averaging into a very bad investment, oh boy, I'm getting more shares, it keeps falling. Oh boy, oh boy, oh boy, until finally, oh, it's not worth anything anymore. It's not going to guarantee. It's not a guarantee. It's not going to turn a lousy investment into a good investment. But it's about as straightforward and as emotion-free investing as we can find. The trick is to find a good mutual fund to do it with. Most mutual fund companies have a system for running hypothetical illustrations. And we've been using these since chapter 12. We've shown these. We showed you for stocks. We showed you for bonds. In this chapter, we're going to show you a balanced fund along with the Investment Company of America for 88 years. So check that one out. They are examples of returns with a lump sum principal. The default is $10,000. You know, we only did one like that because most of us don't have $10,000 lying around the house. And the other one is the stream of investments, which is another name you can use, but I don't think that works. Dollar cost averaging, just $50 a month, or a combination. Say you had an inheritance or some money that falls into your lap, and then you want to start. So I got $5,000. Let's put it in there and let's start putting $100 a month. And they must be approved by the Securities and Exchange Commission, Financial Industry Regulatory Authority. They have to contain disclaimers about past versus future performance. And hopefully you've gone through the ones in chapter 12, the ones in chapter 13, go through the ones in chapter 14. In the face-to-face class, we would stop and do those right now. If you have others that you want to run, maybe $200 a month or $25 a month or whatever, contact me. I can do it. I can talk about this stuff far longer than any reasonable person would ever want to listen because I love this stuff. And the key on slide 23, and you probably can't read all these, but this is the same slide we had from chapter 1. That's not the only mutual fund that has done well over decades. All of these mutual funds have been around for more than 50 years. There's American funds. There's the Dodge and Cox. There's a few nice Fidelity funds. There's Franklin. There's the Invesco we talked about. There's the American Funds, Investment Company of America. MFS is actually the nation's oldest mutual fund company, Massachusetts Financial Services. There's T. Rowe Price. Dreyfus Fund is now owned by Bank of New York. Templeton, part of Franklin, and then Vanguard, and then another American funds. So these companies have been around for decades. And look, 11 and a half, 11.7, 11, 13, 11. Now this is the one I told you back in chapter 1. We really should get rid of that because the reason it's so high is because of Peter Lynch in the 1977 to 1990. It's never returned to its former glory. But look at all these. And so I'm not trying to just sell you Investment Company America. That's just one of them. There it is. And notice it was over 12% by the end of 2021. And since then it's gone down. Everybody's gone down. The key is to think long term. And look, 1967, 1950, 1965, 1967. There's a Investment Company America is 1934, 1948, 1950. 1951. Now, would I recommend any of these? Well, they're all good funds, folks. But again, I try to get people to think global, and all of these are actually domestic funds. Why? Because they just happen to be the funds that have been around for more than 50 years. We did not start to see global funds until the 1950s and 60s, and there were only a few. And here's one of them. The Templeton Growth Fund was one of the ones that was global. T. Rowe Price. Now, I don't think the New Horizons Fund Yeah, no, the New Horizons Fund is global, I think. I have to go back and look. I'm thinking of their other one. What's their other one that's not global? It's done really, really well. But I think so. So most all these funds are domestic, which is not. I'm not trying to badmouth the United States companies. You know, we have some of the best companies in the world, and we have very good innovation. But I like, as I'm repeating myself, my apologies. I want, if you're starting from a clean slate, if you're just starting investing, I think it's best to invest globally. And most of the young people agree with me, whereas some of the older people say, no, 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 I'm fine with the United States. I'm stuck. I like that. And that's fine. It's a big pool to swim in, but I'd much rather swim in the whole ocean. I don't know if the metaphor makes sense, but think about it. So you see, the news is good. If you invest prudently, consistently, long-term in investments that have been around for decades and done well in good times and bad times, you should do well. But there are no guarantees. The world could end, in which case, oh well, it doesn't matter where our money is. I'm optimistic. I'm assuming we don't blow ourselves up, die in our own waste, earthquake, tsunami, meteorite, disco returning. I am very convinced that the next 20, 30 years economically are going to be very good. More people have come out of poverty as a percentage of the world's population than ever before in history. That's a phenomenal accomplishment. And we don't see it on the nightly news, no. But we don't, here in the United States, we're starting to see poverty on a bigger level, mostly in states like California, where the economy is so strong, people can't afford to live here anymore. A strong economy is a good thing, and it's a blessing and it's a curse. But we are seeing countries around the world where the middle class population is growing, and that is a phenomenal accomplishment. And it's also a very good sign for investors, because what happens when people come out of poverty and they're not living hand to mouth, as it's called? They have money in their pocket they never had before, and they want clean food and water, and they want good clothes, and they want shelter, and they want toothpaste, and they want shoes, and they want cell phones, and they want bicycles, and they want television sets and Disney, and yeah, no matter where you go in the world, there's a few places probably not, but no matter where, the smallest little pueblito, you're going to find Colgate. You're going to find Nestle. You're going to find Coca-Cola. And so that's a good sign for us investors, because we want to make money, right? I mean, that's why we're in it, isn't it? And we don't think about this part, but we're a tiny little drop of water in the ocean that is contributing to the raising of the standard of living for everyone, which, again, it's not perfect, but it's better than it was 200 years ago. A whole lot better. So I'll stop now on my pontification and telling you why investing is a wonderful thing, realizing that it is not perfect and there are some horrible things about it, but we're doing the best we can. The bottom line on mutual funds, at least some of us are doing the best we can. Slide 24. Choose a fund family, stick with them. There's a saying in the industry, which is true. Most mutual fund investors do worse than the mutual funds they invest in. That doesn't make any sense. How can you do worse than the mutual fund you invest in? Well, it's actually very easy. You wait until the market goes up 100%. Then you say, ooh, is it too late to get in? You dive into the aggressive growth mutual fund, which then plummets when the markets fall, and you jump out. Ooh, is it too late to get out? Only to see the market jump back up 50%, in which case you rinse, repeat, and shampoo. So you're not going to be one of them. You're going to reevaluate your mutual funds periodically, make changes judiciously and sparingly. You like those words? Judiciously and sparingly. And as you approach retirement, you're going to migrate from stock funds to bond funds, but don't give up on stocks entirely. Check the balance fund that we look at in this chapter, and then we're going to come back to a balance fund when we take a look at retirement. We're going to see that a balance fund in retirement is actually a pretty cool thing. Use dollar cost averaging $50 a month, $100 a month, whatever, for the most part, forget about them. Remember the PETA factor. It ain't there with mutual funds once you've chosen a mutual fund. I know it makes investing boring, but it works. Mutual funds, dear students, should bore you to wealth. Okay, we're done with it. No, actually not. We have one more chapter on investing, and here is when we look for something completely different. We'll take a look at real estate, which the PETA factor is really high, and other investment alternatives that I hope you avoid for the most part, but who knows? You might be the exception that proves the rule. See you in our next chapter when we discuss real estate and other investment alternatives. We are so proud of you. Think of how much you have done. Think of how much you've learned, and you are now the financial guru for your friends and family and coworkers, and we are so proud of you.